moving into chapter 3, this is where we're really going to start looking at things such as trend analysis, financial statement data, how it's used. You're going to start being exposed to some of the ratios that you should already know and see them in just a little bit more of a clear light. So there are 7 general learning objectives to chapter 3's content. Is why are financial statements or ratios important? What is the importance and how can we calculate a return on investment? How do we calculate and interpret margin and turnover using what's called the DuPont Model? What is the importance and the calculation of a return on equity? What is liquidity and why is it important? The significance and the calculations of working capital, the current ratio, and the asset test ratio. And generally, what can trend analysis do for us? Why is it effective in some of our analysis on things like performance? So in all reality, what a ratio is it's a relationship between 2 numbers. The large dollar amounts that are reported on financial statements of many companies and in the varying size of different companies in the same industries really make ratio analysis a really sensible area and way to evaluate basic financial characteristics. Looking at 2 similar companies and large dollar numbers can sometimes add some bias, can add some gray, can add some blur to just looking at the financial statements. By taking away that distraction and looking at the relationship between key numbers, then we can do a more closer to an apples and apples comparison. How is firm A utilizing their assets versus firm B? Firm B, although smaller, may be much more effective at utilizing their assets than firm A. But the large dollars in revenue and the large dollars in assets can add a distortion to somebody who's just looking at financial statements. So we start with trend analysis. Trend analysis is a way that we can help to identify improving or deteriorating conditions. Let's look at an example that illustrates the trend analysis process. Let's suppose that a student's grade point average for the last semester was 3.5 on a 4.0 scale. That GPA may be interesting, but it really says little about the student's work. However, suppose you learn that this student's GPA was 1.9 4 semesters ago, 2.7 3 semesters ago, and 3.0 2 semesters ago. The upward trend in these grades suggests that the student is working smarter and harder. We can do the same thing with any of the ratios. We can take and look at them over a period of time and see what performance has done. Are things improving or are they deteriorating or are they remaining the same? One of the important ratios that a lot of typically investors, but even the companies themselves will use, is related to the rate of return. To calculate the rate of return ratio, the amount of return on an investment is divided by the amount of the investment. This ratio provides the return on a given investment alternative. So we can calculate this for any variety of investments in an organization. This ratio shows that all other things being equal, a higher rate of return, the more profitable the alternative. The basics of the rate of return calculation is derived from the interest calculation. You should long ago have been exposed to the basic interest calculation, which is principal times rate times time. Higher rates of return are typically associated with a greater risk. This is the risk-reward relationship. This analysis is sometimes used in the decision-making process when choosing between two possible and competing solutions. There is not infinite resources. Resources are limited, and you have to make the best decision. Company will engage in a rate of return analysis to ascertain whether A, their investments have performed to the amount that they expect, or B, they'll do it on a theoretical and a historical basis to see which investment alternative is the best option. Some companies will have what they call a minimum threshold. This is an amount of return that has to be made in order for them to engage in an investment. If the historical rate of return for an investment is not at or above this threshold, then that will typically throw that investment out of the consideration pool unless there are other factors to take into consideration. Return on investment is a ratio that you should be able to calculate for any organization of which you have access to their financial statements. To calculate it, you take the return on the investment ratio and divide net income, as all right there on your income statement, by average total assets. Now remember, when we say something like average, to take you back to your counting principles classes, that is what the total was at the beginning of the period, what the total is at the end of the period, add it together and divide it by 2. So we take total assets at the beginning of the period plus total assets at the end of the period and divide it by 2. Then we take that value and divide it into net income. This ratio describes the rate of return management was able to earn on the assets that it had available during that year. An informed judgment about the firm's profitability requires relating net income to the assets used to generate that net income. The purpose of your assets are to help generate earnings and income. This is your basic return on investment, or ROI ratio. There is a slightly different ROI ratio called the DuPont model. The DuPont model is an expansion of that basic ROI calculation. The margin, which is net income divided by sales, which are both components on your income statement, multiplied by turnover, which is sales from your income statement divided by your average total assets. You calculate each of those pieces separately and then multiply them by one another. The developers of this model reasoned that profitability from sales and utilization of assets to generate sales revenue are both important factors that need to be considered when we're looking at and evaluating profitability. Margin is an emphasis on every dollar of sales revenue. It says that for every dollar of sales revenue, some amount, some percentage, some piece of it must work its way to net income. Turnover is an efficiency. And with that, it relates to the efficiency in which a firm's assets are being used in the revenue generating process. Are they being used efficiently? And are they going to bring a dollar to the bottom line? As a general rule of thumb, the DuPont model and its ROI perspective is that average ROI based on net income for most American merchandising and manufacturing companies is going to be between 8 and 12%. Now remember, this is a general rule of thumb. There are very few tried and true absolutes. What you would want to do is you would want to look at the ROI utilizing the DuPont model for an organization over a period of time, compare it to its competitor, and then compare it to its specific industry. Return on equity. This is how much of the net income is a result of a rate of return on the amount of the stockholders' equity. So to calculate this, we take our net income and we divide it by the average stockholders' equity. So the average dollar of stockholders' equity has X amount of income attributable to it. Doesn't mean that that stockholder is going to get it, but we can attribute it back to the equity. So how did it perform? How was it used in the course of this period? Owners are very interested in expressing profits of a firm as a rate of return on the amount of their stockholders' equity. A general rule of thumb is that R.O.I. for most of the American merchandising and manufacturing companies historically ranges from 10 to 15%. We're going to begin talking about liquidity. Liquidity is very important because it refers to the ability of a firm to meet its current obligations and is measured by relating its current assets and current liabilities as reported on the balance sheet. There are three key ways that liquidity is measured: in working capital, in the current ratio, and in the acid test ratio. Let's begin by looking at working capital. Working capital is calculated by subtracting current liabilities from current assets. It is the excess dollars of a firm's current assets over its current liabilities. It is important to have working capital. This allows an organization to embrace opportunities as they come about, allows them to deal with unexpected cash needs, and to evolve and fluctuate with the swings in their industry and or the economic market. The current ratio is a calculation that divides current assets by current liabilities. This ratio is a measure of the ability of the company to pay its current debts as they come due. And generally, as a rule of thumb, a current ratio of 2 is considered indicative of adequate liquidity. However, bear in mind that many companies run with a much tighter liquid position, and there are some that are at a 1 and are considered adequate for their industry. Again, you would want to look at a historical trend analysis of this ratio, compare it to a key competitor, and look at the general industry in which the organization operates. The acid test ratio, which is the quick ratio, either name is one in which it has been known, is calculated by dividing what are called the quick assets by current liabilities. So quick assets are only some of the current assets. They include cash and also temporary cash investments and your accounts receivable. You notice that it kicks out inventory. This ratio provides information about what we can call the absolute worst case situation and the ability of the firm to meet its current obligations if something were to occur and none of their inventory can be sold. It takes out of the equation the potential of slow-moving inventory. And generally, as a rule of thumb, an acid test ratio of 1 is considered to be indicative of adequate liquidity. Like I said, with all of the other ratios, and I will continue to say, what you will want to do is you will want to look at a trend analysis of the ratio over a period of time for your organization. You'll want to compare that ratio to a key competitor. So we're looking at intercompany comparison there. And you will also want to compare it to the industry average. Sometimes an industry has a completely different consideration of adequate liquidity. A trend analysis is the evaluation of some specific data over time. So let's look and remember about the student's grade example. When we just saw the 3.5, it only really just told us they're doing okay. They're doing fine. But when we looked at it as a trend over semesters, going from a 1.94 semesters ago to a 3.5 now, and increasing bit by bit over time, it actually tells us that there hasn't been an improvement. Now, had that student had 4.0s and now was at a 3.5, we could see that there was something going on that was causing a deterioration. As a manager, this would indicate for you that you need to intercept and you need to evaluate and determine what the causation of that is. Also, showing an improvement, you may want to determine what is causing that improvement, and is it something we can not only encourage, but replicate or make a permanent part of the organization. This table illustrates the trend analysis of return on investment, return on equity, and working capital for Campbell's Soup over a 5-year period. From this table, we can see that Campbell's R.O.I. and R.O.E. results were generally downward trending. So we went from 10.0, I'm going to come back over here, 13.7 to 12.3 to 11.6 to 6.2, and then it improved to 10.0 in R.O.I. We see a similar trend where we started at 101.7, filtered down into the 70s, went all the way down to 43.5 in 2013, and then it started to increase in 2014 at 58.2. Although the overall trend in this profitability data presented is downward sloping during the 5-year period, it is difficult to meaningfully interpret company-specific results without understanding more about what's going on in operations and if there might have been some specific industry-based challenges that might have been faced in those specific years. You want to take into account things such as an economic shift, an industry shift, and perhaps something occurred operationally that would have resulted in a sharp and painful downtick in liquidity. This could have been something such as a necessitation to immediately replace key personnel, and in doing so, 2013 was a year of restructure, so therefore it fell very significantly between 2012 and 2013. Could have been that there is something in that specific industry that resulted in poor sales. Poor sales then are going to translate all the way over to your liquidity. One of the things that we also do with trend analysis, because sometimes just looking at numbers and seeing these numbers as they change and go down shows us some things, but what it doesn't necessarily show us is how they relate. Is there something that we can see that may have been causation? We can plot the trends into a graph and see if there was something that triggered it. So perhaps in theory, maybe the turnover, rather than upticking in 2013, had bottomed out. That definitely would have been an issue. We do see that it upticked while margin down ticked. This indicates that there was a increase in expenses that we need to take into consideration. We then can look at things such as the working capital to the current ratio and how they trended over that period. Come to the end of chapter 3. While this is just kind of a high level, a little bit more in depth, let's look at the numbers together type of a lecture. Be sure to have read chapter 3 in its entirety. You know that those questions will be part and parcel in your exam.